Today, we're diving into the essential world of financial management and corporate finance, crucial for any business. Our focus will be on understanding how these disciplines are vital for effective planning and achieving business success. Let's begin by defining financial management and corporate finance, two fundamental pillars of business. These are the core disciplines that underpin all financial decisions within an organization, guiding its economic health. First, let's look at financial management, which is all about the internal operations of a business. It involves planning, directing, and meticulously controlling all financial activities to ensure smooth operations. This discipline focuses heavily on budgeting, making smart investment choices, and managing financial risks effectively. Now, let's turn our attention to corporate finance, which has a broader, more strategic outlook. Corporate finance deals with crucial decisions like capital structure, securing funding, and major investment strategies. Ultimately, its primary goal is to maximize the value for shareholders, driving long-term company growth. Let's explore the key differences between financial management and corporate finance to clarify their distinct roles. Understanding their distinct roles is crucial for grasping how each contributes uniquely to a company's financial health. On one side, we have financial management, focusing on the everyday financial efficiency of the business. Its core focus is on managing financial resources with utmost efficiency to support daily operations smoothly. The scope includes essential tasks like budgeting, detailed financial planning, and rigorous cost control measures. Financial management typically operates on a shorter time frame, handling day-to-day financial operations. Conversely, corporate finance takes a much broader and more strategic view of the company's financial future. Its primary focus is on maximizing shareholder value through strategic decisions and long-term investments. The scope encompasses major investments, optimizing capital structure, and even mergers and acquisitions. Corporate finance operates on a strategic, long-term time frame, dealing with significant financing and investment decisions. Now, let's discuss why financial management is so incredibly important for any successful organization. It's the engine that drives business growth, ensuring stability and resilience in a dynamic market environment. Firstly, effective financial management is key to profit maximization for any business. It helps increase revenue through smart strategies and significantly reduces operational costs, boosting profitability. Next, strong financial management is crucial for effective risk management. It protects the company against various financial risks and unforeseen uncertainties, ensuring stability. Another vital aspect is efficient capital allocation within the organization. This ensures the very best use of all available financial resources, optimizing returns. Moreover, financial management is essential for achieving sustainable growth. It actively supports long-term business expansion and ensures the company's continuous development. Finally, it significantly boosts investor confidence in the company. This attracts vital funding from banks, diverse investors, and existing shareholders, fueling further growth. Let's explore the key financial statements, which are fundamental tools for analyzing a company's health. These essential documents serve as powerful tools for thoroughly analyzing a business's overall financial health. First, we have the balance sheet, a snapshot of the company's financial position. It clearly shows the company's financial position at a specific point in time, like a photograph. The balance sheet details assets, what the company owns, liabilities, what it owes, and equity. Next is the income statement, which reveals a company's profitability over a period. This statement clearly shows the company's profitability over a specific accounting period, like a video. It outlines the revenue earned, expenses incurred, and ultimately, the net income or loss. Finally, the cash flow statement is crucial for understanding liquidity. It meticulously tracks all cash movement within the business, both inflows and outflows. This statement categorizes cash flows into operating, investing, and financing activities for clarity. Every business faces financial hurdles, so let's examine some common financial challenges. Understanding these obstacles is the first step towards effectively navigating and overcoming them for business success. A very common challenge is experiencing cash flow problems within the business. This means not having enough liquidity to cover immediate short-term expenses, causing operational strain. Another significant issue companies often face is high debt levels. Excessive borrowing significantly increases financial risk, potentially leading to instability for the company. Economic uncertainty also poses a constant threat to financial stability. Market fluctuations and unpredictable economic shifts can greatly affect investments and profitability. Compliance and navigating complex regulations can also be a challenge. Strict legal obligations and changing regulations can significantly impact a company's financial planning. Finally, making sound capital allocation decisions is a frequent challenge. Deciding between using debt, equity, or reinvesting profits requires careful and strategic consideration. Let's explore the crucial role of the financial manager in guiding a business towards success. They are instrumental in guiding key business decisions, ensuring financial health and strategic direction. First, the financial manager is responsible for effective strategic financial planning. This aligns financial goals with broader business objectives, driving long-term sustainable growth for the company. Next, they oversee capital allocation, which is a very important function. This involves deciding precisely where to invest company funds to achieve maximum returns and value. Another critical area is comprehensive risk management for the organization. They identify and mitigate financial risks, actively protecting the company's valuable assets from potential threats. Financial managers also focus on continuous profit optimization. This means tracking expenses closely and identifying areas to cut costs and enhance operational efficiency. Finally, they are key in ensuring accurate financial reporting. This ensures accurate reporting and strict compliance with all relevant financial regulations and standards. Now, let's delve into a fundamental concept: the time value of money, or TVM. TVM states that a rupee today is worth more than a rupee in the future due to investment potential, inflation, and uncertainty. This principle is vital for investment decisions, capital budgeting, and loan calculations. For example, investing 1 lakh rupees at 10% interest for 3 years results in a future value of 1,33,100 rupees, demonstrating compounding. Let's discuss another core concept: the risk versus return trade-off. This principle shows that higher potential returns usually come with higher risk, while lower risk means lower returns. Investors must balance their risk tolerance with their desired returns. For example, government bonds offer low risk with modest returns of 4 to 6%. In contrast, stocks, being higher risk, can potentially yield 10 to 20%, but with greater volatility. Let's clarify the distinction between financial management and accounting. They offer different, yet complementary, lenses for viewing and handling business finance. First, let's look at the focus of financial management. Its primary focus is on making decisions to maximize profits and optimize investments. The scope includes capital budgeting, managing risks, and comprehensive financial planning for the future. Financial management considers both strategic long-term and essential short-term planning horizons. Now, let's consider the key aspects of accounting. Accounting focuses on meticulously recording, classifying, and reporting all financial transactions accurately. Its scope covers bookkeeping, ensuring tax compliance, and preparing crucial financial statements. Accounting primarily deals with recording daily, monthly, and yearly financial transactions for historical accuracy. Let's quickly summarize the key concepts we've covered in this session. These are the essential takeaways you should remember from our discussion today. Remember, both financial management and corporate finance are absolutely vital for business success. Financial management focuses on efficient resource allocation and maintaining day-to-day financial health. Corporate finance deals with long-term investment, capital structure, and maximizing shareholder value. Key financial statements like the balance sheet, income, and cash flow are crucial tools. The time value of money and risk versus return are fundamental financial concepts. Finally, financial managers play a strategic role in planning, managing risk, and ensuring profitability.